Next up, we have a session that touches upon a transformative period for our country, Amritkal for India. And the term Amritkal signifies a time of prosperity and growth. And India is very uniquely positioned at a crucial inflection point where opportunities in various sectors are aligning for substantial long-term growth. This session is going to explore the strategic role of capital markets and how investors can harness this pivotal moment to drive value creation. We will also delve into how emerging trends, favorable demographics, and technological advancements are converging to create a unique window of opportunity for both domestic as well as global investors in India. As we enter this golden era, understanding how we can navigate these shifts is going to be key to unlocking superior returns. So, ladies and gentlemen, we are privileged to have in our midst Mr. Vikas Khemani, founder and fund manager at Carnelian Asset Management and Advisors Private Limited. He's going to lead us during this session with over 23 years of experience in capital markets. Mr. Khemani has a stellar track record of building businesses to leadership positions. His deep understanding of corporate India alongside his involvement with industry bodies like CII and FICCI makes him the perfect person to speak on the promising future of our economy. Please join me in welcoming him, Mr. Vikas Khemani, ladies and gentlemen.
Good morning, everyone. Thank you very much, Kamal and team, for having me over, and great to see the hall full of audience on a Saturday morning. That clearly shows the interest in India story. So, welcome. I think one of the things which we always try to do, it's been our core belief that when we invest, what perspective you invest with determines your outcome, right? I'm sure all of you as an investor, time and again hear different sort of stories, perspectives in the market. Many a times, it confuses. Many a time, it clears your thought processes, right? Today, very common narrative has been, which at least we hear as a concern from most of the investors. Markets are expensive. Is it peak like 2008? And other side, you hear India is in a transformative phase. So, what to do, right? Investors who really don't track much kind of gets confused. So at least I'm going to try and build a perspective, and this is how the genesis of this whole fund and the thought process came about, that can we build a perspective for investors, how to look at India, what are the opportunities and what are the potential risks, or what are the potential sort of pitfalls going forward. So over the next 10-15 minutes, I'll try to build that perspective for you, how we see India, from what lenses we see. Hopefully, at the end of the thing, you will be more clear, if not confused. So, as all of you know, that Amritkal is a period of 25 years. By the time India turns 100, Prime Minister has given a vision that India will become a developed nation. What does it mean? And why it is possible this time around, right? That's one big question all of us ask. So first of all, if you see, we all know that India was Sone ki Chidiya. We had a quarter of a GDP in the before British era. India was a very, very prosperous, and so was China. But due to colonial rule, we lost out that to, by the time we got independent, to 2-3%. China also lost out. China started the journey 35 years ago. India started a journey meaningful in last 10 years, right? So as Amritkal plays out, today's GDP, which is about $3.7-3.8 trillion, is likely to go to $29-30 trillion. Our per capita GDP, which is $2,500, will reach to $18,000. Our share in GDP of the world trade will go to about 15-16%, which is currently around 4%. So these are the possibilities over the next 20-25 years, which is likely to happen, right? But more importantly, why it is possible this time around. And that perspective is very, very important, right? So one of the big reason why I think it's possible is, So if you see last 10 years, a lot of foundational work has been done, right? If it's long pending economic reforms have been carried out, GST, IBC, RERA, and many more, right? When they were carried out, we all face the pain, but today in hindsight, a lot of them are helpful, being appreciated, and have helped to contribute, make the mainstream economy, parallel economy into mainstream economy, to bring a lot of efficiency. All those things have happened. A lot of digital reforms have been carried out. I don't think any other nation has carried out as much digital reforms India has carried out, and today all of us can feel and touch that. Infrastructure reforms are being carried out. All of us can feel that India is being built, rebuilt in every nook and corner of the country, roads, railways, ports, airports, everything is built. So a lot of foundational work has happened in the last 10 years. But more importantly, some big tectonic shifts have happened in India's mindset. And that is, ladies and gentlemen, I feel is also one of the big reasons why India is going to leapfrog this. Now let us revisit what are these tectonic shifts in Indian mindset that is going to put us into the next league. Number one tectonic shift which has happened is that India has moved from incremental mindset to exponential mindset. No more India thinks that will take 10 years, 20 years, 30 years to address a thing or problem, right? Today we are doing at a very, very rapid pace. That has a huge economic benefits. Secondly, historically we were told that India is a poor nation, we are a garib country, we don't have money for defense, famous AK and Antony statement, right? Today you don't hear that anymore. We have money for everything. It means India has moved from constrained mindset to non-constrained mindset. We are building world-class infrastructure, we are building money for defense. So that same country, same nation, same everything. But today we don't operate from a constrained mindset. Thirdly, historically, whenever India faced a problem, we look towards West for solution. UN and World Bank will come and preach us. No more the case. We are finding our own solutions to own problems. A very, very self-found confidence for India, right? Fourth, India is innovating at a scale and a low cost, right? UPI, telecom are the great examples. Nowhere in the world, less than $2, you get unlimited data on telephones, right? Including China. So this is our innovation, and this is happening in every nook and corner. We can feel whether it is space, whether lots of innovation is happening, and you are going to see that accelerating only. This has a huge economic benefit, from a growth perspective. Fifth, historically we were taught that either socialism or capitalism, only two models exist. India has beautifully experimented in last 10 years that social welfare and development can coexist. They are not at odds with each other. And last but not the least, when it comes to global stage, India does not sit in the corner. It is sitting in the center, driving the agenda, and being assertive as a nation what a largest country needs to do, and that is how we have found that confidence, and thanks to again our policies and leadership. So all this, lot of this tectonic shift which have happened in our mindset are going to propel India to that next league, and all these changes will drive three things: scale, strength, and speed. We are the most populous nation on the planet, we are the youngest nation on the planet, and we are the most aspirational nation on the planet. Whenever these three things combine, unprecedented amount of wealth creation happens. Go back, all of you are investors in your history, any company which has created in last 30, 40 years any wealth, you will find three common things in those companies: strength, scale, and speed. And that is happening at the country level. And that is what makes us believe that India is going to leapfrog from next 20, 25 years into the next league. And that is this time around possible. Now, what are the major, some of the trends one can look at, as this story plays out? One of the biggest mega trend, which cannot be reversed no matter what, is our demographic. India is, as we know, the youngest country at 28 years of median age. China is 38 and aging. In fact, China has an interesting social problem because of their one-child policy. Every one working couple has 4 dependent parents and 2 children. So 6 dependent, which itself is causing a huge social burden on them. Right? So China is aging. India's 2/3 population is working age population, which is not happening in any part of the world. Right? We will contribute to 25% of the incremental working force of the country, of the globe. These are the trends which cannot be reversed. No matter what, so many people working and consuming is nothing but GDP. And that's the reason, this is the journey which is going to only accelerate from here. Everywhere world is aging, whether it is Europe, Japan, America, China. India is the only, and we will remain youngest for next 50 years. Also, we have seen things like manufacturing, which historically has been India's pain point, beautifully picking up in last 5-7 years specifically. But India's GDP, which is 16% of total, India's manufacturing GDP, which is only 16%, is set to go to about 25-26%. Right? Manufacturing is where IT was in mid-90s for India. And that's a huge opportunity. Our total GDP will grow 16x only on manufacturing front, which was not there before. So when you look at infrastructure, everywhere money is being spent. If you study different trends at different parts of the world, US had this railroad boom. Many of you must have studied that, where US spent almost 30% of GDP on building railroads. After that, they had 3 decades of economic boom. India is spending 40% on the railways only, and many more. I mean, ports, airports, railways. So India is spending massively. Whenever you spend money on infrastructure, it has a huge multiplier effect. Those are things which are coming and going to come in much more size and scale. So every aspect you look at today, India is, I think, progressing in a really big way. Our financial system, again, one of the best in the world. Our banking has gone through huge amount of challenge in last 20, 30 years, but post IBC, post a lot of cleaning up which has got done, it is very, very well placed. Just to give you an idea, total banking credit today, it's $2.5 trillion. 20 years ago, in 2001, it was $125 billion. So in last 20 years, we have grown 20x, right? Despite all the problems and all those things. The next 25 years, this $2.5 trillion will grow, even if it's just a little bit moderate high rate. It will go to 65 to 70 trillion dollars. Our total GDP today is $4 trillion, less than $4 trillion. The credit will go to that level. So this is the kind of, when you look at number in perspective, you basically get that, my God, this is possible, right? So this is going to happen in front of our eyes. If SBI mutual fund grows at 20% per annum, in last 20 years they have grown at 25% per annum, their assets, they will become size of today's BlackRock, which is India's world's largest asset management company. If ICICI Bank grows at 15%, it will become size of JP Morgan in next 25 years, which is in world's largest bank. So when you see 15% is not a large growth. But if I say ICICI will become JP Morgan, world's largest bank, it's hard to fathom. But when you see in the context of 15%, it's possible. It has happened, it will happen. So the point I'm trying to tell you, when you look at things slightly with a long-term perspective, with the picture which emerges in our mind is very, very different. So lots of sort of trends are going to play out. Just broad numbers I am going to give you. Total corporate profits of India last year was $150 billion. $150 billion. 2001, it was $8 billion. In last 20 years, now think about all kinds of risk. UPA 1, UPA 2, global financial crisis, 3G scam, coal scam, Fragile 5, demonetization, GST implementation, ILFS crisis, pandemic, Ukraine war. You can name the crisis which could happen, has happened. Right? Despite that, our corporate profits $8 billion to $150 billion. Now, if I was making this presentation in 2001 and I told this audience that in 20 years' time, 4 companies will have more profit than $8 billion individually, I don't think anybody would have believed. Today, 4 companies' individual profit is more than $8 billion. In 2001, more than $1 billion market cap companies were only 20. Today, we have 600 companies. In 2001, more than $10 billion market cap companies were only 2. Today, we have 100 companies. In this period of all the chaos and this and that. So what I'm trying to tell you is that when I've been in the market for 25 years, when I looked at this data, we were making this presentation and all, I couldn't figure that so much has happened. I couldn't relate, because we live in market and day to day, you don't relate that this has happened, so much has happened in this period of 20 years, So the point I'm trying to stress upon is that the more longer you keep your horizon, you start building, you start seeing what is possible, what is not possible. And I do believe that numbers, we had no company more than $100 billion market cap. Today, we have 3 companies. So we will have $1 trillion companies also in this country in next 20-25 years. Earlier, $1 trillion market companies were not even thought in US. Today, US has $1 trillion market cap companies, right? Many of them. So the point I'm trying to, if you understand what is going to happen in India in next 20-25 years, the perspective you can build, then your ability to stay through thick and thin remains very high. And investing is all about investing with the right perspective from a long-term perspective. One thing you must have heard from everybody commonly, that look at India from long-term perspective, right? And once you have this perspective that what is possible and what are the underlying trends, then you can remain invested through thick and thin, is what I was trying to sort of say here. I mean, these are some of the numbers. I will probably not go in each of them. Consumption, by the way, again, is a very, very big opportunity in India. You will see, so many people earning more and consuming. What happens? I mean, if you see, this is the household income of the graph of the, how as per the income profile, households positioning. The bottom is narrowing and top is sort of widening. It means everybody, whichever is class they are in, they will consume more new and better. As you consume more new and better, you will have lots of sort of opportunity within the consumption. So today, very rare situation where I believe that, every segment is doing well. Manufacturing is doing well. Banking, financials are doing well. Consumption is doing well. Infrastructure is doing well. Services are doing well. A lot of people are calling out that IT is going to go away. That is again a complete misunderstanding according to me. AI will disrupt IT industry. I think every time there's a technology transition which has happened, it has created bigger opportunity. Total IT industry in 2001 was about $10 billion. And post Y2K, I think, and Bangalore is the capital, where am I talking, but $10 billion has gone today to more than $200 billion. In this period, many technological transitions have happened. ERP, digital transformation, AI. So industry has adapted and grown bigger. NASSCOM has guided that it will become $500 billion. When IT industries grows, a lot of job gets created. Number of GCCs, Global Captive Center, which are being opened today, are 100 a year. When they happen, I think huge amount of opportunity come. So what I'm trying to tell you is that when so many things come together, the amplifying effect of so many things is always more than sum total. So that is the kind of potential opportunity which is there in India. On the liquidity front, because ultimately, the point I forgot to say that the total $150 billion total corporate profits, markets are some result of only two things: earnings and liquidity. So earnings, I said $150 billion last year, $8 billion in 2001. This number by 2035 will go to $1 trillion. 150 to $1 trillion. And by 47, $2.5 trillion. So let's right now keep 47. If we only were to talk 35, $1 trillion, it means our market cap will be between 20 to $25 trillion, which is today $5 trillion, thereabout. So you are talking about 5x market growth in next 10, 12 years. That is, and if people like us, outperform market a little bit by 3-4%, you can make 7-8x money or 5 to 8x money in this period, depending on how market plays out, right? So the point I'm saying that, so earning growth is very, very solid. Now let's talk about liquidity, because that's also important. If we did a number, if domestic investors, today they are 4.7% of household savings is exposed to equities. 10 years ago it was 1%. So we did a number, if this 4.7% by 35 goes to 10%, China is 15, US is 35, we will receive $2.2 trillion of additional money only from domestic investors. Forget foreign. If foreigners were to become equal weight, we will get additional $1.5 trillion of additional money from foreigners. And it has to come, it will come. It's a matter of time. So on a $5 trillion market cap, you have $5 trillion more money coming in. I don't need to tell you people sitting here that earning is there, liquidity is there, wealth creation has to happen. Right? It will happen. It's just a matter of perspective, matter of time. And that we will see in front of our this thing. A few words on risk, because I think that's a very, very important aspect, right? There are two kinds of risk: structural risk and tactical risk. Tactical risk, short-term risk, volatile risk will come anytime. Nobody can predict, nobody can plan. You have to live with it. It's like, who would have thought that China monetary policy will create volatility in India? I don't think any would have kind of guessed that could happen, but it happened recently, right? So I'm keeping that part out. But let's see structural. Historically in India, last 20, 30, 40 years, any period you look at, structural risks have come only from 5 factors. Current account deficit. Whenever our current account deficit is, we import more, export less. Whenever our current account deficit goes out of hand, our economy struggles. 2012, we became part of Fragile 5. Raghuram Rajan had to do that bond when our current account deficit became 4.5% of GDP, right? Today, that has come down to around 1%, and it's next 5-7 years, it will become surplus. Meaning we will import less, export more. So as that happens, we don't need money from abroad, right? Current account deficit is funded by the capital flows. So whenever, current account deficit goes out of hand, we become dependent on foreign capital, and that brings volatility. Today, in 2012, taper tantrum caused our currency to depreciate by 20%. This time around, US raised interest rates by 5% and our currency is holding solid. That tells you what kind of decoupling has happened. Right? Second, fiscal deficit. Again, we are one of the best managed fiscal deficits around the globe. And given the fact, the way our tax collections are there, we are very solid. Third, whenever financial system has gone into trouble, our NPA cycle, whether it was 2001 to 2012, 2018, NPA cycle goes out of hand, our economy suffers. Today, our banking sector is one of the best placed post-IBC, post-digitization. Gross NPA is around 2.5%, 3%, net NPA is 0.5%. Never ever happened in the history. Fourth, inflation. We are again one of the best managed inflation in the world, right? Imagine if we didn't import Russian oil, our economy would have been struggling. So it's very hard to put value to the accidents avoided. We have very, very nicely managed our inflation. And last, debt to GDP, corporate debt to GDP. Our debt to GDP, corporate debt to GDP is one of the lowest in the world at 75, 78%. Corporates are hardly levered, right? But big risk comes from leverage, right? Even in the markets, with the margin funding going down, SEBI taking 50% margin and only few stocks, even margin funding is not there. Earlier, a small fall will get accelerated by the margin funding selling. Today, that doesn't happen. That's the reason you don't see many more corrections. One of the speakers was saying that when did we see last 10% correction? Very rarely it happens, which used to come very often earlier. So that kind of structural repair which has happened in the market. So the big risk, big deep cuts, why it does not come is because of the structural repair which has happened to the economic profile. Now, another big risk which gets talked about, I'm just taking because this the common questions we get, hence I'm just kind of putting together. Other big question which comes, that risk will come from global factors, right? So what if US is sitting on all-time debt, high debt, and what if something happens in US blow up happens? What can happen to us? Can we stare at global financial crisis kind of thing? So my answer to that is, I'm not expert at US. I cannot figure out what will happen in US. A lot of people have been saying about US blowing up for a very long time. I can't do that. We can assess if this were to happen, what will happen to Indian economy or how it is different than global financial crisis. Once you get that perspective, it will help you. So why did global financial crisis, what was the big reason? Mortgage crisis, right? If you all remember, right? Because of the mortgage situation in US, global financial crisis got triggered off. But India did not have mortgage situation. Then why did India import that? Why did India face similar problem like US or any other market? The big reason for that was linkage with the economy. That time, if you remember, in 2008 or before that period, the cost of capital in US was cheaper. So most of the Indian companies used to borrow there for investments in India. Today, cost of capital is cheaper in India. No companies borrow abroad. Mortgage in US is 6.5%. In India, it is 8%. So capital is expensive there. So today, last time what had happened in 2008, companies like Hindalco had bought Novelis, Bharti bought MTN, Tata has done JLR, Chorus. All those big acquisitions were done using abroad funding. So now as funding went out of the question, all those global acquisitions came into stress and the stress came on the Indian balance sheet. And Indian companies started looking bankrupt. Today, fast forward, no Indian company has any major global borrowings. So if something were to go wrong on the funding side there, the impact on Indian companies, Indian economy will be minimal. I am not saying that it will be nil, but it will not be to that proportion. Second big factor was there, that time, a lot of Indian banks had balance sheet abroad. ICICI Bank had 30% balance sheet abroad. Right now it is 1 or 2%. So no bank, so last time what happened? When problem happened abroad, their balance sheet, overseas balance sheet came under stress and Indian companies started looking suddenly bankrupt. Your 30% of the balance sheet, if it's under question, obviously you are bankrupt. So this time around, we don't have those global linkages, either the business level or financial. So if you have this perspective, then, you know that, there is no structural weakness. So the always thing I like to say is that all these, which I mentioned, the 5 parameters, they are like, vitals of our body. You can't stop viral attacks. Viral attacks will happen. But if our vitals are strong, then we will only have 2-day fever and we'll come back. But if our vitals are weak, then we'll go to ICU or it may be a fatal case. So that's how one should understand. Investing is very simple. Once we have this perspective, I think one can really stay invested through thick and thin. And I can tell you, and this has been our view for quite some time, when most participants have been calling out markets are expensive, markets are, look, there's a lot of risk. We've not said that. We are fully invested. We have complete faith in Indian economy. We think we are in one of the best wealth creation cycle of our lifetimes. In this time, optimizing for 5%, 10% correction, which nobody anyway can time, makes no sense. It is nothing beyond man ke shanti. We all do a little bit here and there, but it doesn't serve the purpose. In fact, it only creates a dent in the portfolio. So that's the perspective I wanted to leave you with. My favorite saying of Bill Gates is, we always overestimate what can be achieved in 1 year, underestimate what can be achieved in 10 years, which is I was trying to show you through a lot of numbers and all. Our human mind is always able to comprehend what happened in the recent past and cannot see very, very long perspective and pictures. So this is the thought I thought I will leave you with. Happy to take any questions if there are. And maybe I can talk a minute about Carnelian. Carnelian, we are 5 years old. We manage roughly about 10,000 crores across various strategies. We've always tried to do things little ahead of the time. So, of course, we have many funds, but our first fund has delivered almost 26% CAGR post all expenses over last 5.5 years. We launched our manufacturing fund. Please note this. We launched our manufacturing fund called Shift Strategy in October 2020. 6 months after pandemic, when nobody believed that manufacturing in India can be big. That fund, the next fund came in 23 and 24. That fund has delivered 47% CAGR over last 4.5 years. We recently launched this Bharat Amritkal fund, which is basically idea is to invest from a next 15-20 years perspective, and create significant alpha. So our idea is that you can create money, you make money, you can create alpha by differentiated thinking. You cannot make money, you cannot create alpha by just, me too kind of thinking, run-of-the-mill kind of thinking. You need to think differently. You need to think, your perspective determines your outcome. And that is what my attempt has been today to share with you. Happy to take questions. Sigma events which you can't prepare, you can't plan. Like, let's say, could you have predicted COVID? You could not have, right? Similar kind of thing, let's say tomorrow some cyber attack happens. You can't predict, you can't model, you can't wait for it. You can't be, so you have to take those kind of risks, though they will come. But the structural risks are not there. Only other risk which I did not cover potentially can happen tomorrow. Some major political disruption happens, but I believe that also will not happen because I told you many political changes happened in the last 20 years. And despite that, India has created good wealth. India is one of the best performing market in the world in dollar terms in last 20 years. In 2002, Nifty was 800 points. Now you can imagine what CAGR in last 20 years despite all the risks I talked about. So the point I was trying to tell you, I don't see major structural risk in India. Unexpected short-term risk will come always. But investors have to remain invested through thick and thin. The benefit of perspective like this is that you don't get shaken up all. And there's no answer to invest. You don't invest into markets, you invest into companies. So there's no answer to investing into good quality business and good quality management at right price.
So there is a competition for freebies. Will that impact our economy?
My closing. Competition for freebies, what is the impact of that? That's a question, right? See, it's a very interesting question. I don't see, like I mentioned, one of the point that India has beautifully experimented social welfare and development can coexist. Please understand, it's sitting in this AC room, it's very easy to, we don't feel the pain of people who are, we have a very large population at the bottom of the pyramid. World is talking about universal basic income for how long? That every individual deserves a basic good life. Today, India has delivered that. World is still debating. India has delivered through the direct benefit transfer to the poorest of the poor, whether to provide toilets, to provide banking account, to Ayushman Bharat. And that is good. By the way, it is not bad. It is very good. Today, think about it. Your labor in your factory earlier did not have access to Ayushman Bharat or treatment. Right? If something happened to him, he will be off for 8-10 days without, his productivity will get impacted. Today, he has access at low cost to that. It is impacting the productivity of the country. All those things, see, they are very small in the overall context, I can tell you. And if it goes on the other side, there's a balancing factor. It is still not very large, I can tell you. You're right that if it goes all the way around, but by the way, world is moving towards populist. India is still managing it very well. So historically, Indian society, see, as your demographics changes, historically, the mindset of Indian society has been, save, utna kharcha karo jitna chadar hai, right? But the new generation, Gen Z, millennials are not of that mindset. So India is going away from that, if earlier, if our parents, by the time they were 50, 60, if they bought a house, it was a great deal of achievement for them. Today, a youngster, once he gets a job of 10 lakhs rupees also, he'll buy a house. Now, technically speaking, it's a good thing to do because you don't have to wait for 60 years to get a house. You are income and you are able to now, that covers into the debt. But that's a good debt because you are having a house, you are instead of paying rental, you are paying EMI, right? So part of it is not alarming at all. We are nowhere close to, when it gets to alarming. Some unsecured loans, some pockets. And one thing I will always tell you that a lot of time narrative gets created by looking at a small pocket. Some IPO getting mispriced, some overvaluation stock in the market. Using that, don't color the whole market as a bad market. Today, one or two incidents or few incidences, they'll say, oh, markets are expensive. So I'm saying there will be some pockets of unsecured loan, microfinance loan, which are there for sure. But that is not threatening, that is not risky for the country at all. So we have to see in the overall context, not and this is going to go further up, by the way.
Yeah. Hi, good morning. I have a question here. So, what are the themes that you're looking ahead? That's the first question. The themes looking forward. You said you're thinking a little differently as Carnelian.
वही तो बताया इतना सारा अभी.
No, going forward, what are the themes, particular themes?
Manufacturing, consumption, infrastructure, financials, services.
Okay, and the second thing, doesn't it expose investors to too much risk? When you have
hold closer to the mic, I can't.
Yeah, when you play themes, doesn't it expose investors to too much risk, key man risk particularly in terms of Carnelian?
Key man risk.
Key man risk.
When you invest?
Yeah. So in the past you have performed because you invested in manufacturing. It worked out well. Now going forward, people would have a similar expectation that you'd pick the right themes and get the right return. So would you want to touch some light on that?
No, so see, biggest risks today, if you ask me, it's a good question. What is the biggest risk today? The biggest risk today is the risk of high expectations. Everybody thinks that it's easy to make 30%, 25%. That's the biggest risk, not the market is risk. So I don't think we should increase our expectations. Somebody asked me how much return you will deliver. I say 15 to 18%. Anything comes about, aap hi ka hai na. When I launched my manufacturing fund in October 2020, investors asked how much return you think is going to generate. 18-20% is what guidance we gave. How much it came? 47%. I have not taken away. It is investors' money only. The point is, again, biggest secret to success in investing is invest with the long term and low expectation. So don't increase your expectations looking at the past. Risks will come, I am telling you. There will be periods of no return. There will be periods of negative return. There will be periods of very, very low return. But that does not mean that the journey to $20 trillion is there. That I don't doubt. Yeah.
Are there any triggers or indicators to anticipate corrections in capital markets? And if, to take advantage of those opportunities?
Yes, toss the coin.
Sir, I wholeheartedly share.
I'm not joking. I can give intelligent sounding answer, but that will be like tossing the coin, nothing else.
And what will be your risk management policy as a fund in these situations?
Don't invest in the crooks. Invest only in good quality management and good quality business at a right price. No other risk management. Because investing is long term. If you, let's say market, like I said, viral attack will happen. You cannot predict, you can plan. But if my portfolio quality is strong, like you give an idea, Amritkal, few statistics I'll give you, the fund collective level, ROE, earning growth is 25%, ROE is 19%, debt to equity ratio is 0.1%, PEG ratio is 1.1, beta is 0.7. So if your quality of the portfolio is good, there will be correction, will come back. That's the only risk management.
Vikas,
Yeah.
Why do you think the FIIs are very cautious at this stage?
FIs are not cautious. They have been selling for last 3 years. In FI, very good question. See, FIs sell. It is not that they are selling for India. Whenever Fed raises interest rate, if you last 30, 40, 50 years history, whenever Fed raises interest rates, they pull money out of emerging market. Why? Because emerging market runs current account deficit. So whenever money gets pulled out, the currency depreciates, economy weakens. So whenever Fed is raising rate, they pull out money from emerging market. India is emerging market. So after last three and a half years, when the Fed was raising rates, money got pulled out. Right? And I have said many times in the media last 1 year that when the rates get peaked and starts coming down, you will see flows coming. And that is what is happening, that after Fed just gave first indication, we saw a lot of flows. Of course, last 1 month we lost some money because China tactical allocation is happening, but that's tactical. I am again telling you, I have no doubt in my mind that foreigners will come into India. We will not be able to handle, there will be avalanche of capital. I am saying this with seriousness. I am so happy that this time around domestic investors are buying. Because at least we will make first money. Historically, foreigners made money first and we bought later. This time around, domestic investors are buying and probably will sell them. That's a good thing. But I have zero doubt that foreign money will come. It's already started, except last 1 month because of China. And like I said, $1.5 trillion over the next 10 years, give or take here and there, will be there.
Hello, sir.
Yeah, go ahead.
Sir, we wholeheartedly agree with your optimism about the India growth story. In your shift strategy portfolio, you're heavy on small caps. So what is your inclination towards small caps and managing beta with small caps?
So, yes, good question. Beta is a risk. What is beta? Beta is a short-term volatility risk. Somebody who worried about the volatility risk, there are 3 kinds of risk. Risk of permanent loss of capital, risk of mark-to-market, and risk of opportunity loss. Somebody who's worried about the middle one, the volatility risk, should not invest into mid and small cap or should manage their portfolio. Somebody who's worried about permanent loss of capital and opportunity risk, actually we wrote a note also, the real risk lies in business and the management. If I like a business and a management, I would rather buy it small than after that, right? So small and mid caps are real pot of opportunity, provided you get a right management and right business. And we look at from that lens. Right? Manufacturing, why we have mostly mid and small cap? Because they aren't large manufacturing companies. We are at a very early stage of manufacturing cycle. How do I find large cap companies? Large cap company is like saying in mid-90s, Infosys was only 2,000 crore market cap. But today Infosys is wide. So we will have many Infosys of the world in the manufacturing space.
Hello, sir, here. You are talking about demographics. Is here.
Yeah.
You're talking about demographics, so you said that India is very young and the rest of the world is aging and things like that. So where do you go from here? Because India being the youngest country, where average age is 28 and or something like that. But most of us are, the large population of the younger generation is unemployed and unskilled, and I think around 25% of the Indian population is totally unemployed when compared to the other ASEAN countries like Vietnam and all, where the employment rate is just 2%. Here is where somewhere around 25%. So with this large chunk of unemployed, unskilled, which are totally unemployable youth, where do we go from here? And with these geopolitical tensions, I think after the Second World War, we have around 90 conflicts in the world right now going on. So this is, a lot of amount of great deal of geopolitical tensions. So where does the market stand, compared to this?
I think the unemployment is a valid point, but always one thing, always look at, I always say that world is neither utopia or dystopia. Always look at, one of the biggest learning of my life of 25 years of investing is look at rate of change. Are we employing more people than yesterday? Answer is yes. More people, are we creating more opportunities? Like I was saying, there was a time when, nobody was taking civil engineering. Today there's a huge demand of civil engineering. So today, whether it is manufacturing, whether it is construction, whether it is services, when a global captive center comes and opens and hires 1,000 scientists in a Bangalore or Hyderabad, what does it do? Right? It creates demand. Number one. So I think we are definitely creating, and look at the EPFO data, year after year for last 10 years, it is increasing. So that is job creation only, right? So as the job gets created, it has a huge multiply effect. One manufacturing job in a formal creates 3 informal jobs. So we don't see those data. So there is, today I am telling you, if you ask any businessman what is the biggest problem, getting manpower, number one. As far the skilled and unskilled is concerned, see, skilling happens, provided, so there's a crude saying, I say that, dhanda hai, to supply ho jayega, demand hai, to supply ho jayega. We are all entrepreneurial people. Like example I like to give, there's a company in Kolkata makes metro coaches, indigenously. Who would have thought 5 years, 10 years ago that India we will make metro coaches, of our own capability technology. How did we make that? Where did the talent came? They hired people from Siemens and Honeywell and all, and they built that capability. So capabilities gets built, provided there's a demand. So today good news is there's a demand, and that gets created. So this unemployed youth is our opportunity, and that is going to feed into our growth. Regarding geopolitical, I think we are going to remain for next 10-15 years in a heightened geopolitical environment, because the real game is between US and China. Everything else is all proxy wars. Who is, superpower? So this is going to remain. I don't know an answer how it will settle, but the only thing I can say, sadly, war is good for business. Nobody cares who is dying where, honestly. The only reason historically wars mattered, only reason why war mattered was oil price. Otherwise nobody cares, to be honest. Right? Today we have seen, because of our smart policy of importing Russian oil, oil, despite all the heightened, oil has not gone anywhere, right? If that is the case, I'm assuming that will continue the way we have been managing. So I think my take is that geopolitical will continue. We don't have structural weakness in our economy. It's being managed very well. Risks will come, we'll handle and we'll move on.
All right, thanks.
Thank you. I think, super.